Federal Reserve aftermath, interest rate repricing and Bitcoin market response. Welcome back to our next Research and Insights video, Event Studies. In this event study, we examine one of the most important macro catalysts currently influencing the Bitcoin market, the Federal Reserve aftermath. As we know, the Fed kept interest rate unchanged, but the message underneath the decision was more important than the decision itself. Markets were not reacting only to the rate hold. They were reacting to the repricing of future policy expectations. Instead of moving closer to the rate cuts, investors are now reassessing whether interest rate may stay higher for longer. For Bitcoin, this matters because Bitcoin is highly sensitive to global liquidity, real yields, the US dollar, and risk appetite. When interest rate expectations rise, liquidity pressure increases. Also, when Treasury yields rise, risk assets face valuation pressure. And finally, when the US dollar strengthens, Bitcoin often struggles to attract aggressive inflows. This event study analyzes how the Fed aftermath transmitted into Bitcoin through three major channels. First, US Treasury yields, second channel, the US dollar index, and finally, market expectation for future rate cuts. So let's begin with together. So let's start from event shock overview. The event is classified as a hawkish hold that led to liquidity repricing shock. The Fed didn't raise rates. However, the up-to-date policy tone reduced confidence in near-term rate cuts. This creates a macro repricing event. The market had expected a more supportive liquidity environment. Instead, the Fed signals caution on inflation and maintained a restrictive stance. For Bitcoin, the immediate interpretation was negative, not because rate increased immediately, but because future liquidity expectation weakened. This is the key point. Bitcoin does not only react to the interest rate. Bitcoin reacts to the expectation path of liquidity. When markets believe rate cuts are delayed, Bitcoin loses parts of its liquidity premium. Also, when markets believe policy eases is approaching, Bitcoin usually becomes more attractive as a risk asset. At the current stage, the Fed aftermath has shifted Bitcoin into macro-sensitive compression regime. So, let's start from Treasury yields, the transmission channel number 1. The first transmission channel is US Treasury yields. That rising Treasury yields creates pressure on Bitcoin in several ways. First, they increase the opportunity cost of holding non-yield assets. Second, they reduce speculative risk appetites. And third, they tighten financial conditions. After the Fed decision, short-term yields move higher as market reprice the probability of a tighter policy. This matters because Bitcoin is especially sensitive to the front end of the yield curve. When 2-year yields rise, the market is usually pricing a more restrictive Fed path, and that creates a headwinds for crypto liquidity. Here, in beta G dynamics terms, this is a macro pressure signals. If yields continue rising this week, Bitcoin may remain capped beneath resistance. If yields begin falling, the pressure may ease and Bitcoin could recover. So the key signals to monitor is simple. Falling yields support Bitcoin and rising yields pressure on Bitcoin. Transmission channel number 2. We want to discuss about US dollar index in this part. As we know, the second transmission channel is the US dollar index. A stronger dollar usually creates pressure for Bitcoin because global liquidity becomes tighter. And when the dollar strengthens, capital often moves toward cash, treasury instruments, or defensive assets that reduce demand for speculative assets. Bitcoin can still rise during the strong dollar environment, but the probability of clean upside expansions become lower. For this event study, the US dollar index is one of the most important confirmation signals. If the XY weakened after the Fed aftermath, it would suggest that markets are rejecting the hawkish interpretations. That would be constructive for Bitcoin, in fact. But if the XY continues strengthening, Bitcoin may remain vulnerable to reject rallies. In the current regime, the dollar is not just a currency signal. In fact, it is a liquidity signal. A weaker dollar means easier global financial conditions, and stronger dollar from the other side means tighter global financial condition. And for Bitcoin, this difference is very important. Transmission channel number 3, rate cut repricing engine. In fact, the third transmission channel is rate cut repricing. Before the Fed decision, investors were looking for signs that rate cuts could become more likely. After the decisions, the markets had to reconsider that assumptions. That is why the Fed aftermath matters so much. Bitcoin benefits when the market expectation is easier monetary policy, and rate cuts usually means lower discount rates, improved liquidity, and stronger risk appetites. But when rate cuts are delayed, Bitcoin loses part of that support. This does not automatically create a bearish trend, but it reduces the probability of immediate upside expansion. In BitJ Dynamics language, the markets moves from liquidity expansions to liquidity repricing uncertainty, and that means that Bitcoin may continue compressing until the market receives clearer signals from yields, DXY, and Fed speeches. In the next part, we want to analyze together Bitcoin regime responses. Bitcoin's current regime after the Fed events can be described as macro-sensitive compressions that lead to expansion pending. The market is not in a clean bullish expansion phase. In fact, it is also not yet in a full bearish breakdown phase. Instead, Bitcoin is absorbing the macro shock. Price behavior after Fed events often become noisy. The first reaction is not always the final reactions, and this is why confirmations matters. If Bitcoin stabilizes while yields stop rising and the DXY weakens, the Fed shocks may be absorbed. That would create conditions for recovery attempts. But if yields continue rising and the dollar strengthens, Bitcoin may remain under pressure. The key point is that Bitcoin is now trading inside the macro confirmation zone. The next directional move depends less on internal crypto narratives and more on macro liquidity signals. Bullish scenario. First scenario. The bullish scenario requires a three confirmation. First, treasury yields must stop rising. Second, the DXY must weakens. And third, Bitcoin must reclaim resistance with a strong volume. If this condition occurs, the market would interpret the Fed aftermath as a temporary shock rather a sustained liquidity threats. In that case, Bitcoin could recover from the compression and attempt a renewed expansion move. The bullish interpretation would be the Fed was hawkish, but the market has already priced in it. And under this scenario, Bitcoin could benefit from the short covering, renewed ETF demands, and improved risk appetite. However, without confirmation from the yields and DXY, bullish positioning remains premature. The bullish trigger is not simply a green Bitcoin candles. In fact, the bullish trigger is macro confirmation here. Next scenario, bearish scenario. The bearish scenario becomes stronger if yields continue rising and the dollar strengthens. In that environment, Bitcoin may face a liquidity drag. A stronger dollar and higher yields can reduce institutional risk appetites. This would increase the probability of rejection from the resistance. If Bitcoin fails to reclaim key technical levels while macro pressure remains elevated, the market could shift from compression into downside continuation. The bearish interpretation would be the Fed has a delayed liquidity support and the Bitcoin is repricing lower because financial conditions are tightening. Under this scenario, rallies should be treated carefully. They may represent as bonus traps rather than sustainable reversals, and the key bearish confirmation would be rising yields, stronger DXY, weak ETF demand, and Bitcoin failing near resistance. In this level, we want to analyze or event classification. This event is classified as a high impact macro liquidity events. In fact, the event type is not purely directional, it is conditional. The Fed decision creates a pressure points, but the market response depends on follow through. Or interpretation is that hawkish hold, liquidity repricing, yield pressure, dollar sensitivity, and Bitcoin compression. The event impact score is high because it affects the core macro variables that drive Bitcoin medium terms regime. The most important conclusion is that Bitcoin is now more dependent on macro confirmation than internal crypto momentum. This means traders and investors should avoid isolated interpretation, and Bitcoin price action must be read together with Treasury yields, DXY, Fed species, ETF flows, and risk appetite. This Federal Reserve aftermath represents one of the most important macro events for the Bitcoins on this week. The Fed kept rates unchanged, but the market interpretations the policy message as a hawkish and shifted attentions away from the immediate rate cost and toward the possibility of higher for longer financial conditions. For Bitcoin, the key issue is liquidity, as we know. If yields fall and the dollar weakens, Bitcoin may recover and return toward an expansion setup. And if yields rise and dollar strengthen, Bitcoin may remain under pressure and face rejection risk. The current beta G dynamics regime classification is macro-sensitive compressions that lead to expansion pending, and the market is not giving a clean directional answer yet. This is waiting for confirmations. The most important signals to monitor this week are US Treasury yields, DXY, Fed member speeds, ETF lows, and Bitcoin ability to reclaim resistance. The objective is not to predict the Federal Reserves. In fact, the objective is to understand how the Fed changed the Bitcoin regime, and because when the more regime change, Bitcoin probability structures with it. Thank you for watching this Beta G Dynamics Research and Insights. We will continue the monitoring macro liquidity, institutional demand, and Bitcoin regime transitions throughout the weeks. And our analysis take place based on this scientific research that you can find it from Applied Economic Journals, Integral and Francis, the US dollar volatility spillover, and competitive effects on Bitcoin returns dynamics and mining behavior. Thank you so much for your watching.